retain still quite a defensive positioning. We think that the risks are not gone. And I think one of the biggest things for us is the debt problem. And while, for example, when you look at the European situation with the LTRO, we know that no European bank is going to fail, but debt remains a problem. And we think while all that debt is out there, growth will remain weak. And that's one of the main reasons for remaining cautious on the level of stocks and what markets can deliver. I think that what's important to note is 2011 was very much a risk-on, risk-off year. And I think what we're going to, as moving into 2012, some of that focus will move away from these tail-end risks to the kind of growth that's likely to come over the next few years. And that's where we believe that growth will remain weak as long as this debt problem remains. And the bottom line is there's no quick way of getting out of the debt. It'll take time to work its way through. And while that happens, growth is likely to remain weak.
Let's look at the local market and the overall market where it sits right now relative to emerging markets, relative to global markets. If you just look at the past 10 years or so, South Africa's market has caught up to where global markets are at. At the start of the 21st century, we saw it at around 40% discount to global markets, and we're pretty much sitting on par right now when you're looking at the PE of the market. Does this mean that we're going to track sideways for some time now? What does this mean for where to from here for the Aussie?
Yeah, for us it's a relative valuation game. So when we're looking at our market and we're comparing it to, say, the developed market out there, and we look at, say, PE multiples, if you have a stock, and a good way of explaining it is if you have a stock like SAB that's trading on about a 16 times PE multiple, you can go out there and find another global brewer, and something like maybe Carlsberg comes into mind, that's trading more on a 10, 11 PE. And for us, that valuation gap is significant. And that's why when we look at the fund and we're looking at positioning, we try and look for offshore stocks that are offering the more value than what we're seeing from some of the local counterparts.
85% of your fund is invested domestically. So let's focus in on the domestic equities that you have a strong exposure to. MTN stands out as your top holding. Walk us through the investment case for MTN right now, sitting at around a 10.8 PE.
Yeah, we still like MTN. We have about 9% of the fund in MTN. And I think there are a few important points. Firstly, MTN delivers a very defensive earnings stream. You know, its earnings are a type of utility in nature. You know, people aren't going to make less calls simply because GDP is down 1%. So it's a very defensive earnings stream. And the other reason we like MTN is I think the cash flows that you're going to see from MTN going forward are going to be very strong. And the important point is they're looking to return more and more of those cash flows to investors. So we think things like MTN being on a dividend yield of around 6 or 6.5% is very attractive. It's likely that we'll see them doing share buybacks once they announce results. So these are all positive things that we like about MTN. And again, stressing the very defensive nature. It's diversified. It's in 22 countries in Africa and Middle East. So that diversification and those defensive earnings streams is what we find attractive.
When we talk about stocks that have exposure to the Middle East, Sasol, of course, stands out. It's your third top holding when it comes to local equity. So, of course, your portfolio very much weighted towards a player like Sasol. It's a very popular stock, especially with foreigners. What type of risks are you attaching to Sasol right now, given its exposure to Iran and given its exposure to the oil price, which, of course, is elevated right now, but there are risks that it could come down, and then it also has exposure to where the rand goes?
Yeah, look, we still like Sasol. We bought in the fund sort of below 300 rand. We think closer to 400. It's sort of nearing more its fair value. Issues around Iran are a concern, but it's not a big part of Sasol's business, and we think the risk around that is manageable. And then the other point is, you know, Sasol remains a very good rand hedge. And our view on the rand, for example, is we think the rand is too strong. And while it's been driven still by foreign inflows of money into our bond and equity market, those flows can reverse very quickly. And we think Sasol would do very well in a weakening rand situation. And again, when you come back to valuation, Sasol's trading probably around 8 times PE, again, which is quite attractive for us. When we look at other industrials, or you know, when you look at stocks like SAB or Richemont that are trading north of 14, 15, 16 times PE, you know, Sasol does stand out as being attractive.
When we're looking at the resources sector, we know that the platinum sector has been particularly hard hit. There are a lot of supply side issues that the likes of Impala Platinum is facing right now. It's got ongoing strikes at its Rustenburg mine. We don't know about the future of its Zimplats holdings, its Mimosa mine in Zimbabwe, but yet you're choosing to put money into the platinum sector when other investors are choosing to avoid it like the plague. Why is that?
When we look at the platinum stocks, price determines how we see value. So if you look at all the platinum stocks, they've underperformed our market for a very long time. The last year there were some of the worst performers in 2011, and I think from that value has come into the platinum stocks. And they're going through a number of issues. We know Implats is going through and trying to deal with the strike at the moment. And the platinum price has not been as strong as, for example, what the gold price has been. So we think that combination of a commodity price that's not elevated, unlike, say, we think iron ore and copper prices are very elevated and the risk is to the downside. Platinum is not as elevated in terms of the commodity price. But again, turning back to valuations, when we look at these platinum shares on their price to book and look at their long-term price to book, they are trading at very attractive valuation levels on that basis. And there have been periods in the history of these platinum stocks when they approach those sort of valuation levels, you tend to find that the subsequent long-term performance is very good.
The retail sector is one that you're choosing to avoid like the plague, yet JD Group is a standout holding that you have right now. Steinhoff wanting to take a majority stake in the company. Walk us through the rationale behind investing in JD Group and why you're choosing to stay away from other retail stocks.
Just starting off with the retail sector as a whole, the retail stocks have done very well over the last 8 to 10 odd years. We were buying retailers when they were trading on 8 to 10 times PE levels. Today they're trading on 14 to 16 times. But the other important thing is when you look at the level of earnings out of the retail sector as a whole, it is very high level of earnings, and that for us brings in more risk in terms of buying them as investments now. The one thing we like about JD Group is that it is not trading at a very high earnings level, so its earnings are pretty depressed. So you have that margin of safety in terms of a low level of earnings. And I think some of the restructuring they're doing around the tie-up with Steinhoff is good. I think they're going to look to take out costs out of the business and look to expand their offerings as well. And I think that bodes well for the future. And the other important point is when you look at the foreign ownership of retailers in our market, most of our retail stocks have between 40, 50, 60% owned by foreigners. And it hasn't been a South African specific thing. Emerging market retailers have all done very well, and a lot of money has been piled into emerging market retailers. And JD Group stands out as one where you haven't had the foreigners participating, so you don't have the risk when they do pull out.
We know that the rand has had a tremendous rally. It was sitting at around the 750 level this morning. It managed to break below that level. The big question is, how sustainable is this rand strength right now, and how's that impacting your decision to invest offshore?
We do think the rand is too strong, and whether you look at it on purchasing power parity basis, it does show up as being too strong. But there are a couple of reasons that has been driving the rand stronger. And I think when you look back to how the markets have reacted since sort of the last quarter of last year, the rand has been strengthening. And this is on the back of, again, the search for yield. And I think when risk is on and investors are looking for yield, the rand, a lot of foreign money tends to come into our market. And that's what's driving the rand stronger. We think, again, longer term, there's a risk of this money flowing out. And again, it's not only a South African phenomenon. Emerging markets as a whole have attracted a lot of foreign capital. And I think the risk remains, as we've seen in the past, when the financial crisis hit and money flowed out of the country, we saw how the rand depreciated considerably. And we still believe that risk remains. So wherever possible, we're trying to position and trying to hold companies that we believe will do well in rand weakness. And again, the offshore exposure does help in terms of that rand hedge.